on to Defiance ETFs, which you guys are the sub-advisor as well. So let's talk about QQQY JEPY. I will admit that these are massive positions in my retirement accounts. They're fully on drip. So everything is just reinvesting and reinvesting. So it's been a while. It's been over 6 months now, I believe. It's not quite been a year. So tell me, what is your general sense? Like, are you happy with the performance? How is it doing a daily option on the NASDAQ, on the S&P 500? You guys have a Russell one too. It hasn't been out long. I'll just focus on the NASDAQ and the S&P 500. So what's your general take on the performance thus far on both of these?
Yeah, I mean, we're happy with them. Obviously, they've definitely seen some strong growth. We went through a period of lower volatility, right?
Yeah,
Kind of before maybe before the April sell-off that we saw. But the first 3 months of the year, volatility was lower, so yields were a little lower, right? Distribution rates were a little lower. But then, as you see what happens you get a volatile month like April, and all of a sudden distribution rates go up again. So it's
yeah,
one of those things that I think. Some folks might not have realized that, oh, it's so tied to volatility, but these are really pure, option premium plays. Yes, we're capturing some of the upside every day when we sell those options, those in the money puts, but the real driver of that distribution is volatility. And
yeah.
so it's been a nice little chance for people to realize, like, oh, April was volatile. Hey, look, yields were distributions were a little higher when it came to the QZ JEPY and IWMY. So we're happy with them. Lower volatility is good for the upside capture, not as good for the distribution rate. But higher vol means things could be a little scary. Well, that's what these are there for. These kind of harvest and capture that volatility. The daily trading has been going very well. Market makers fills are good. The process is all working well. So we were happy to, we like to say we were the first doing daily options out there with these funds, because we really were, right? We're putting an option on at the close that expires the next day. So again, really important for us just to continue to, to kind of pave the way for this kind of a product,
Yeah.
and the market has been receptive.
Yeah, both of the distributions have jumped in April, which I expected because volatility jumped everywhere. So these are completely tied to volatility and performance wise. I think they're doing quite well compared to their competition. I was randomly checking JEPY versus SPY, for example. Now, disclaimer: I don't know how accurate this thing is, this website, but JEPY, which is the S&P 500, is slightly outperforming SPY, which is very popular from Neos. Of course, the granddaddy is JEPY, right? Which is not the entire S&P 500, but JEPY is outperforming JEPY as well from the data that's here. Again, disclaimer: I don't know if it's 100% accurate. QQQY, however, seems to be a bit underperforming or lagging a little bit. The JEPQ one, of course, now the graph is not gonna show. Oh, there we go. Not
Right.
not by much, but there is a little bit of underperformance with JEPQ. So listen, I had a crazy theory. Maybe I'm crazy. If I am, you tell me. Okay.
Okay.
I think the way these funds are structured, I'm just curious because you're literally the only guy I could talk to about this. So because of the daily, it's a daily. It resets every day, right? So these will always outperform the SPY or QQQM if the market is flat or is going down because of the premium, right? And it's very clear. Like I had a video where I basically show my stock app and I have QQQ, QQQY, JEPQ, and I do the same thing for the SPY, JEPY. So if the market is flat or down or up a tiny bit, typically these ones will outperform that day. Where they underperform is when there's a big up market, right? Because let's say the NASDAQ or the S&P
Sure.
goes up
Because they're
2%.
capped.
Because they're capped. Exactly. So
Yes.
it's really about, if these are going to outperform, it's about, the best thing would be that the markets are basically flat or go up a tiny bit every day. So my theory is, and correct me if maybe I'm crazy here, would this daily strategy work better for the S&P 500 than the NASDAQ? Because the S&P 500 is typically doesn't go up as hard as the NASDAQ does, and is typically more calm, more, there's less movements on a day-to-day basis because I guess it's more diversified. I feel like maybe this strategies would work seems to be working better for the S&P 500 than the Nasdaq. Am I crazy, or what do you think about that theory?
All right, so I guess it all depends on what you're trying to achieve, right? You're kind of talking when you compare QQQY to the Qs, you're now talking total return, right?
Mm-hmm,
But
mm-hmm.
let's face it, right? And I've said this before, the goal of these is not outperforming total return. The goal of these is to generate that alternative income, harvesting volatility. So if your goal is harvesting volatility, generating that income from, selling options every day, then the higher the volatility, the more income you could make, which is why the distribution rate is higher on QQQY.
Right.
However, you do have with that higher volatility a bigger chance for a drop, or your drops are deeper and your rebounds are harder. So the risk of the underlying strategy, like any covered call strategy, we like to compare the in the money put strategy as the same risk profile as a covered call. They are.
Yeah.
Whenever you're going to cap the upside, right? Those big rebounds are always going to limit on your upside. But if you were to look at, even the Russell one, which has an even higher distribution rate because there's more volatility in the small caps than there even is in the technology stocks, you will see a higher distribution rate. So, well, look, again, it comes down to what is it you're trying to achieve? Is it total returns, or you're trying to achieve the higher distribution and higher dividend rate? That is going to answer your question. I don't love comparing these necessarily to their underlying components, because that's not the goal of them, to beat the underlying index, right? The goal of these is to, like you said, regardless of a market environment, generate that, those income, generate that distribution. And you're right, in a flat market, these will outperform. And in a down market, these will outperform. But again, to me, I don't normally like to compare them to that, because if you want on the Qs, then on the Qs, right? Like,
Yeah.
that's easy and it's cheap, right? If
Yeah.
you want, though, the income and you want the dividends and you like the distributions and you like the reinvesting and you like the great things you do with your portfolio, then these are a different kind of vehicle for that. These are the ones that you're going to like, that high distribution, and almost you could count on it, right? I mean, even though we had low volatility, the rates were still fairly high. We didn't go down to a 15 or 20% distribution rate. They stayed, in the higher echelon. So it's one of those things. It's all depending on what you're trying to achieve with those. So I don't know if I'm dodging your question or not. You're not wrong about total return. So I would say, yes, you're correct. But again, if it's about total return, these might not be the right products for you to use in the first place.
That's for sure. Yeah,
Yeah.
yeah, yeah. No, it makes complete sense. It makes complete sense. Before we move on, what do you think of what I feel is probably some of your only competition with these daily, the ones from Roundhill, QDTE, XDTE? They just came out. Do you have any comment on these? I mean, they seem very similar, except they're not doing the in the money puts. They're actually doing calls, which is kind of the same thing. They have weekly distributions. I thought that was interesting.
Yeah.
Are you guys thinking about switching to weekly? Are you, or no? You're happy with the monthly. What do you think about these?
So, look, I always welcome healthy competition. It also tells you that there's acceptance to this type of strategy.
Hmm.
So good stuff there, right? I'm okay with the Roundhill guys, what they're doing. Strategy is a little different, like you said, because they're selling calls versus then the in the money approach. I also believe they're not entering their positions at the close. I think they're entering them at the open, correct? So there, I always felt,
Each
capturing that.
morning, yeah.
Yeah, so I always felt capturing the risk in like the volatility and the overnight risk is actually important to capture, right? So I don't like, if my goal is to harvest volatility, I feel like they're leaving half of it on the table, selling, in the morning. Now, there might be a different, set of results from in the, the end results and the total return. But to me, if my goal is, harvesting one day option volatility, then I want to capture the whole day, right? So that has been our theory. That is what we've stuck with. The other thing I would say to you is, you asked it where would we go to weeklies. We discussed it.
Yeah.
I think there's been enough, enough misunderstanding about what happens to the NAV of the ETF when you have distributions, right? Because when you distribute, the NAV drops by that amount. I think we felt monthly is fine. Doing it every week might kind of exacerbate that misunderstanding, and so we've decided to steer away from going weekly.
Yeah, okay, cool. That was going to be my next question. I know you and Sylvia have talked about this a billion times. I have talked about it a billion times. I've had multiple videos trying to explain to people that this NAV erosion is a myth because, like you just said, every X date, that dividend comes from the NAV. So if you're distributing, if you have yields of 30, 40, 50, 60%, of course you're going to see a downward trend of the stock price because the stock price, the stock chart does not show or does not include the dividends, right? If you just hit
Right.
QQQY or JPY, you go on Yahoo, click max, it's minus 20, 25, 30%, but the return is actually positive, right? And I do
Correct.
my best, my friend, to show this. I bought QQQY, JPY at the beginning before the first distribution. I put them all on drip, and my investment value is higher than what I put in. So even though the stock chart has gone down. So have you figured out a better way to explain this probably number one concern, question, misunderstanding people have on these funds?
Sure. I think the newness of this kind of a product, right, whether it's the Defiance funds or even the Yield Max funds, the newness of these means people aren't used to knowing what to look for. So that's the first thing, right? Like the easy answer I tell people is, hey, look at Yahoo Finance and look at the adjusted, entry and exit date, right? Like the entry and exit prices, and you'll see there's appreciation. Or like what you said, look at the value. When you have it on drip, the value in your portfolio is actually getting bigger. That's what we're all trying to do when we're investing, right? So the way that I've always explained this is, look, we're giving away the upside and we're getting paid to do that. We're turning around and distributing what the income we brought in out to you,
Everything.
but everything, right? We
Yeah,
give it all
exactly.
back, right? Like we taught, like not every fund does that, right? I don't think QYLD does it. I
No,
don't know
they
if
reinvest most of it.
they hold a lot of it, right? And
Yeah,
so look, we wanted to create something that was a little different, and so we distribute all of it. And so, when you only get some of the upside, this is the structure of covered calls or the in the money put. You're going to have a limited upside capture, and you have all the downside risk. And for that, you get paid that dividend. When we hand that dividend back to you, you have to include it in the math, right? Because
of course.
that was the give up. Right. So I continue to say it's about the structure. You're right. It's not NAV erosion. We don't have contango from futures. We don't have, kind of the compounding of leverage working against us. The whole reason why over time it drops is due to the distribution rate that we have. Plus, by the way, if the underlying stock or the underlying index goes down, there's that too, right? Like if you have a drop in the NASDAQ, QQQY is going to go down. We know this, right?
Yeah.
That's okay. But and everybody should know that's the risk they take in these kinds of funds. You still take the underlying risk.
Yeah, the
You're going to
Nasdaq
get
risk or the S&P 500 risk or the Russell
That's
risk
right.
for sure, of
Right.
course.
Yeah, that's it. So yeah, I wish there was a better way to continue to explain it. I think folks would just have to get used to it over time. It's education and communication like this that'll hopefully help convey that.
Yeah, my personal opinion, I did a video on this, a couple of videos that got a lot of views. I feel that these really high yield ones, like we're talking, 25, like QQQY and maybe YMAX, and they're not exactly ideal to live off. So there's a common misconception, or people think, when you hear living off, in people's minds, it's I'm just going to take all my dividends and spend them, right? So I
Right.
feel like these are not ideal to do that because it's like selling most of your investment every month. It's like buying QQQ and selling 4% of it every month or something like that. So I feel
Yep.
like my opinion, the best way to handle these is to drip everything. Or if you are living off of it, you have to reinvest some or a portion. I do a whole video about that. And my sweet spot is like between 10 and 15% yield is decent to live off of, which is what the markets generally give. So I'm just, I mean, I still get these questions. I still get, why does it drop every month, even though it should be quite obvious that's the X date and that's going to be given out. So what do you think about that? These funds are, do you feel like the best strategy is to drip everything? Is that the number one way to hold these funds?
Yeah, again, based on your goals, then
On your
that'll drive
goals.
the answer. So in your situation, and generally our default recommendation is by reinvesting, right, you will add to your position size regardless, right? So you add more shares, even though the NAV price goes down, your value in your portfolio should go up over time, right? I mean, if they're doing their job and the markets are going up, all those kinds of things, right?
Yeah.
So generally, yes, generally we're you should put these on a drip, right? That's the whole point. You can compound so quickly when you're earning 50, 60, 70% in distribution rates. I think IWMY broke 100 this past month, right? So you reinvesting those allows you to compound the size of your position. However, I have had folks say, look, I was going to pull out a certain percentage of my portfolio anyway to live off of. What's the right number?
Yeah.
And, look, in our industry, for many, many years, the number was you should be able to withdraw 4%. There was a 4% rule that
The
people
4%, famous
4%.
4% rule.
Yeah, so the famous 4%. I'm not necessarily a buyer of the 4% rule, but I do think if you want to take, let's say 1% a month, right? The 10 to 12% a month, if that's what you want to take, and that is something that maybe should be the high end of what you want to take out, and you should drip the rest. Again, it all depends on the individual who I'm saying this to, but to me, that would seem to be, between 4 and 12 is a range that should work for you. Take out what you need, not more than what you need, because you would rather compound it. We've all heard, right? The most powerful force in the universe is compounding, right? That applies here, and they're compounding so quickly just because of the distribution size, which is
Yeah.
why we decide to distribute it back, right? We want folks to understand that dynamic.
Yeah. We got to be honest here. I mean, the stock price will keep declining over time. There's probably going to be reverse splits, just like Tesla. A lot of people are scared about that, even though reverse splits and splits, regular splits and reverse splits don't really do anything. Do you have any comments on that? People are worried that they might be, yes, I'm compounding, but the price keeps going down over time. What would you say to someone who says that?
Yeah. So first and foremost, again, depends on the underlying stock, right? You talk about Tesla, and the underlying stock Tesla is, you know, fair, had a rough go,
Yeah,
right? It's everyone, nobody, they want to kick it out of the Magnificent Seven even, right? So it's having a rough time. So the underlying, again, like you said before, if you're bullish, then own that stock, own that ETF. But if you're bearish, then you shouldn't own the individual stocks. Or if you're bearish the market, owning QQQY isn't going to save you from the decline, right? So that's first and foremost. I'll give you some examples where a bullish move actually caused the NAV to increase, right? MVDY is in that case. MSTY is in that case. CONY is in that case, right? Coney, NVIDIA, MISTY, all have had appreciation, and you see the NAV appreciate. And you know what happens when that occurs? The distribution rate, even if it stays at 5, 6, 7% each month, the size of the dividend is even bigger now. So I would say they're not always all going to decline, right? There's plenty of NAVs in the YieldMax universe that are above 20. I think in the Defiance universe, not as many. I don't think any of them are over their launch price. I'm just looking at it right now. So you might have reverse splits, but it's okay. Reverse splits are fine, right? Your value is what matters. The value in your portfolio, which is why dividend reinvestment matters, and a reverse split, it won't change that value. Yes, maybe you might lose a share in the rounding of the 1 for 2,
yeah,
right? Hey, if I had 21, and you do the 1 for 2, I got 10 in cash, right? Instead of getting 11 and a half or 10 and a half. But the value is what really matters in the portfolio. And so I think as folks get comfortable and familiar with that, that's fine. And then the distribution rate will stay the same. It won't change any of that dynamic.
yeah, yeah, for sure. Yeah, it's I totally understand that. It's just, I guess, people, like you said, need to be educated, need to get used to it. I think
It's a
with
little
time it'll,
optics. It's optics, but it's not financial reality, right? You're
yeah.
right.